Hello, and on this episode of the Mortgage and Protection Podcast, we have Paul here from Brick to Brick Mortgage Solutions to explain how an interest-only mortgage works for first-time buyers. It's great to chat with you again, Paul. How's it all going?
Yeah, going well, thanks, Tessa. How are you doing?
Oh, good. I'm glad to hear that. And yes, all good too. Thank you. So, as you know, we've got a list of questions here to cover. So, first of all, and to recap, really, what is an interest-only mortgage?
A mortgage where you only pay the interest. So, for example, if you had a 25-year term, then at the end of the original term, the mortgage balance is still left on there, so that you wouldn't have paid any capital off it. So it's basically interest only. So you're just paying the interest and no capital. You'd still see 250 grand loan, for example, at the start. 25 years later, it's still going to be a £250,000 mortgage. Okay.
Right, okay. Yes, which is clear there. Thank you for explaining that. A great start. And actually, the next question, of course, leads on from that. Naturally, can a first-time buyer get an interest-only mortgage?
Yes, they can, but criteria on interest only is really tight in terms of the amount of deposit you have or the equity there is in the property. Also, how you plan to repay the mortgage at the end of the term. It is pretty normal on a buy-to-let, but not as common on residential. I understand that these questions are based on residential, aren't they?
Yes, that's right. Yeah. Okay, brilliant. Thank you for that. And then, of course, the next question, with all that in mind, follows on. So, are interest-only mortgages typical for first-time buyers? But you touched on it there.
Yeah, I mean, they aren't really, because as most first-time buyers want to start paying their mortgage balance off and not just the interest on it. So they are heard of, but they're not very common. That's all.
Right, okay. Well, there we go. And then, of course, again, people would like to know, Paul, how do I know if an interest-only mortgage is right for me?
And you'd come to us, and what we'll do, we would look at the whole situation, because what we do is have to figure out whether this is right for you. We would need to look at the pretty much the scenario and see which position you're in, as every situation is different, really. So we need to look at the whole thing, then we can advise you in the right way.
Right, okay, which makes sense there. Thank you for that, and something to bear in mind. So let's continue on to this question. How much do I need to earn to get an interest-only mortgage?
Interest only criteria is pretty tight, so a lot of lenders need 75,000 or 100,000, or sometimes even more than that in the background. But there are a couple of lenders that you don't need an income level. This would still need to fit on the income multiples, though, as with a normal capital interest mortgage that's required to reach the balance that you would like to achieve. Yeah, so like I say, there are a couple that don't have a minimum income, but they have other criteria. So we'd have to sit down and have a chat about the requirements, really.
Right, okay, there we go. And then just following on from that one, how do you calculate an interest-only mortgage payment?
To calculate an interest-only mortgage payment, all you do is you multiply the loan amount by the annual interest rate and then divide that by 12, and that gives you what the monthly payment is.
Oh, there we go. Nice and clear there. I'm glad you did the maths, though, the figures. Right, let's move on to this question. What interest rate can I get as a first-time buyer? Anything else to add here?
At present, on the 21st of January 25, for anyone that's listening, the rates are mainly in the 4%, but when you get up to the 90% loan to value category and above that, then it's creeping into the 5%. You won't get an interest-only mortgage at this higher level anyway, not at the 90% and above. It has to be a lot lower than that.
Right, okay, there we go. So a point to bear in mind there. So let's move on. Is it hard to qualify for an interest-only mortgage, especially as a first-time buyer?
Yes, the circumstance is, like I say, it's different to capital repayment because the circumstances are different that they look at. As briefly mentioned, the income levels generally need to be quite high, but we have access to a couple of lenders where this part's fine. There needs to be a repayment vehicle in place with all interest-only mortgages, and what that is, the lender requires to know, and also this is for regulatory purposes as well with the FCA. A repayment vehicle has to be in place, such as how you pay it back at the end of the mortgage term, such as it could be sale of property and downsizing, or an ISA or pension in the background. You also need a larger deposit.
Right, okay, there we go. And speaking of deposit, Paul, the next question asks, and it's always a popular one, isn't it? But in this case, how much deposit do you need for an interest-only mortgage?
25% would be the minimum. This is generally going to be capped on the interest only element at being 50% or 60%, then the remaining percentage would have to be on capital repayment. That's just pretty much most lenders. If you want full interest only, most will go to the 50% loan to value, but then there are a couple that would stretch to the 60%.
Right, okay. So hopefully that's clear there now when it comes to the deposit. And then I suppose here, just in summary, really, you've probably touched on a few of these points, but what are the pros and cons of interest-only mortgages? Is it worth doing an interest-only mortgage?
The main pro really is lower monthly payments. That's what people mainly go for them for in a residential. The cons are basically that you're not paying off the mortgage like we mentioned. You're making payments and you have to pay it off somehow at the end one day. And you do need a bigger deposit, like I mentioned, and they are higher risk on the whole because they have potential more to go into the negative equity situation.
Right, okay. There we go. So it's always a good idea to weigh up those pros and cons, isn't it, there? So that's useful. And then just lastly, I mean, you've demonstrated this already. You always do, Paul, but how can a mortgage broker help here? Have you got anything else you'd like to add?
No, not really. Just like I've said before, really, we'll help you right from the initial thought that you have, and then guide you through the process to the eventual completion. Which is normally the day that you get the keys. So that's all completed then. So we'll help you all the way through, so you know what's happening through the process.
Okay, there we go. Well, hopefully that sounds reassuring to anyone listening to this. Thank you for that, Paul, as always, and I'm sure we'll catch you on another episode soon.
I hope so too. Thank you, Tessa.
Please note, your home may be repossessed if you do not keep up with your mortgage repayments.